Hello. Today I'd like to talk to you about the loan approval process and what we look for in order to get you the credit that you need. In a previous session we talked about credit scores, and having a good credit score is very, very important, both to lower your rate and to make sure you are able to be approved. But in addition, we look at things like collateral value of the item being purchased, and debt-to-income ratios. So let's take most of our time to talk about debt-to-income ratios. At Gerber, we are typically looking at no more than 45% of all your total debts compared to the total income that you bring in. So, as an example, if you brought in $2,000 per month, then you could have no more than $900 in total debts to get a regular policy approval from us. Now, there are always mitigating factors, and we have approved people who have more than a 45% debt ratio, and that's why you work with us and your credit union, because we are able to make exceptions to these types of things. But that would include a car loan, that would include a credit card payment, that would include your housing expense, whether it be rent or cost of purchasing a home via a mortgage. If you're talking about a mortgage, included in that is going to be your principal and interest payment, the assumed escrow for property taxes, and an assumed escrow for insurance, otherwise known as PITA, principal, interest, taxes, and insurance. And that number typically we want to be no more than 20 to 25% as part of the overall 45%. And then the others, student loan payments, car loans, more credit cards and the like, would make up the remainder of that, up to 45%. So how you adjust for that is a lot of times people will refinance existing debt to lower the payment by extending the amortization. So they might take their mortgage from a 15-year payback to 30, which will lower the payment. It might raise the rate a little bit. It will be easier on your monthly budget. The only issue with that, and something to consider, is that over the life of that loan now, since you're paying for an additional 15 years, you're going to pay a lot more in interest on that than if you were able to buckle down and keep it on the shorter term. So when you get something in the mail that says we can lower your payments, well, the way they're lowering your payments is by having you stretch it out over a much longer period of time. So be very wary of those types of things. The other thing we look at is on loan approvals is collateral value compared to how much we're lending you. So in a lot of cases, let's say you're going to buy a car, we can lend you fully 100% of the cost to acquire the car, including taxes and title and all the rest of the things that need to be filed at the Secretary of State's office. Again, that's somewhat dependent on what your credit score is. So the better the credit score, the more we can advance against the purchase of the car, including sometimes greater than 100% of the purchase price. If you have a lower score, then we might be able to only approve 80 or 90% and might require a down payment. So just a couple things to consider as you're going through the loan application process and how we look at things. Debt to income is very, very important, no more than 45% of total debt to the monthly income you bring in, and then collateral value and how much it's going to cost to bring what you want to purchase and how much we're able to advance. Thanks for watching.